Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Welcome. I am Nick. The focus of attention from the different analysts that we follow in the press as well has really shifted away from inflation to the potential for a significant fracture in global financial markets. It already started with the Bank of England having to prop up the pound and gilts prices, government bond prices, immediately after that shock mini budget by Kwasi Kwarteng, Liz Truss's Chancellor of the Exchequer. But it's not just that. We've had some fairly worrying moves in credit default swaps in European banks, in particular Credit Suisse. It looks like that warning that Michael Howell has been telling us about for the last few months, that the Federal Reserve will continue tightening until something breaks, is potentially just around the corner. So I'm going to be talking about different opinions from different economists, analysts that we follow with regards to this potential financial accident that is waiting for us just around the corner, potentially, and also how that would affect asset allocation. Cross-border capital, very interesting discussion, as always, on liquidity and how the Federal Reserve is diverging from other central banks. Its actions have directly impacted the US dollar, sending it to 37-year highs versus the pound, 24-year highs versus the yen, 20-year highs versus the euro. So the world is entering a strong dollar crisis. Julian Garron from Macro Strategy Partnerships, he's talking about the end game. When will the Fed turn? So he's talking about four preconditions. And the first three haven't been met. They refer to political pressure, unemployment, bank lending statistics. All of those would signal that the Federal Reserve continues tightening monetary policy. But the fourth one, the collapse in global excess US dollar liquidity and the potential for forced selling, creates an increasing likelihood that credit stress may emerge earlier, bringing forward the end game, i.e. a Fed pivot. We are getting closer to the point where deflation offshore will feed through to deflation onshore. There's growing divergence between the Fed and the US Treasury's tightening policies and the stimulative policies from the other main trading blocs, China, Japan, the EU, and the UK. When policy between the US and the other main trading blocs diverges, you tend to see major moves in global macro, starting to see it manifest itself in a strong US dollar crisis. A very similar message from Edison. Over the summer, the talk was of inflation and rising interest rates, while during the autumn it has shifted to financial accidents and earnings. We expect the slowdown in the economy to accelerate, easing inflation concerns, but adding the risk of declines in earnings forecasts. MRB, similarly, we expect the Fed to soon emphasize that its hawkishness has peaked. Any near-term upside CPI surprises will not elicit further increases in the Fed's policy path beyond the projected 4.6% peak rate. Financial stability concerns could trump the Fed's inflation mandate next year. So the Federal Reserve doesn't just have one mandate. It's in fact got three. The first one, inflation. The second one, employment. And the third one, financial stability. The Fed, according to MRB, the Fed now faces a potential threat to its third de facto policy mandate, which is that of a well-functioning financial system. This is a quote from MRB. We expect that the Fed will clarify that its hawkishness has peaked and that any near-term upside surprises to inflation will not elicit a further upgrade to the policy path or the terminal policy rate. The Fed needs to emphasize that it sees a 4.6% policy rate next year as being sufficiently restrictive, regardless of the near-term trajectory of inflation, and that it would be prudent thereafter to wait as prior changes in monetary policy fully work their way through the economy before making further policy changes. There is, of course, a lag effect between monetary tightening and the impact on economic activity. The Federal Reserve will be mindful of the huge error that it made in 2021 by ratcheting up stimulus too aggressively, putting us currently in the inflation predicament that we are currently. It will want to avoid making another massive error and creating another deep recession and potential depression in the global economy. Turning now to the ECB likely to raise its benchmark rate by 75 basis points before too long, no surprise there, and thereafter expect further hikes of 25 basis points rather than the 50 basis points currently expected by consensus forecast. Central bank will become increasingly cautious. Interest rates are likely to peak at around 2% by early next year. And looking at the 10-year government bond yield in Europe, using the German Bund as the benchmark, currently around 2%, will likely fall back to around 1.25%. Big decline. Asset allocation, capital economics. First of all, the outlook on bonds, long-term interest rates. Since central banks and most advanced economies seem to have turned even more hawkish recently, we now think that long-dated bond yields in most developed markets will end this year near their current level, not higher. And they expect significant declines in yields next year as central banks eventually pivot towards looser policy. Despite this, we do not think that stock markets are yet out of the woods. Growth in the US economy falling below its secular trend would point to profits dipping below trend as well. More challenging outlook for both the economy and corporate earnings will see stock markets grind lower. But they're sticking with their view that in 2023 and 2024, we will get very strong equity market returns. 15.4% global, 12.7% US, and these are annualized returns for each year. Europe, 23.7%. So the highest returns expected in Europe. ECR also favor Europe as their top pick for 2023 and 2024. Developed markets, Pacific 20.2, Latin America 15, emerging markets, Europe and Asia 14.8, emerging markets, elsewhere 16%, so very good returns. MRB, asset allocation, they also expecting Europe to outperform. Europe, excluding Germany, and Germany as well, very strong overweight recommendations for that region. I'm just going to now turn to the UK, starting off with JP Morgan Cazenove. They maintain the FTSE 100 as an overweight. The UK interest rates and foreign exchange volatility are likely to abate as the government continues to adjust its course. Looking at valuations of UK markets, the UK equity index, the FTSE 100, continues to trade at a record discount to other regions, currently at an 8.6 times forward PE multiple. The weaker pound is a significant tailwind for UK equities. 70% of earnings in the FTSE 100 are derived from overseas. The UK also offers the highest dividend yield globally compared to other developed markets. There is blood on the streets. It's time to get excited with making new investments.
Hi, Nick. Thank you. Locally, firstly, Process. They made a bid for a company called Build Desk in India. It's a fintech company, a very big one. And they offered $4.7 billion, which is massive. But that deal fell through, unfortunately. The deal was subject, just in South Africa, to several conditions. And one of the conditions was to get the approval of the Competition Commission of India. Something missed and they lost the deal. Secondly, Mr. Price, they made an offer for Studio 88. There were certain conditions that had to be met. It was met. It's also a big price. It's 3.7 billion rand. The deal went through and the money was paid over last week. MTN, we all know they made an offer to buy Telkom. Now another company with the name of Rain, they also want to buy Telkom. So there's a fight now between the two. And we'll have to wait and see what's going to happen there. Stadio, we own Stadio. Coronation announced that they bought more shares in Stadio. They now own no less than 16% of Stadio. And Anglo American, we own Anglo American and they own De Beers. So indirectly, we own De Beers. The 8th cycle has been completed and they sold $500 million of diamonds. FirstRand, interesting. FirstRand happened this morning. The Federal Reserve Board of the USA, they announced yesterday that it has approved the application of FirstRand to establish a representative office in New York. So FirstRand is now going to New York. And another thing you might have noticed that this FirstRand has a new modernized logo. The old tree logo is gone. I don't know why they've changed it, but probably in preparation for their move to America. And then I think this is a most important notice is that Transnet has declared a force majeure on all its harbors because the employees began a strike. And that is going to hit our minds very, very hard. We own Kumba, for example, through Anglo American. And Kumba estimated that the production that they will lose with the exports is 50,000 tons per day for the first week. Thereafter, 90,000 tons per day, and it can even go up. Foreign net buying of local equities on the stock exchange stands now at 72 billion. And then statistics. Our foreign exchange reserves, that is foreign reserves that the Reserve Bank keeps. It has edged lower to $58 billion, down from $59 billion in August last year. And then manufacturing production for August, it rose by 1.4% year on year. It was the second straight month of increase, and it was important 2 months of increases while the expectations was a drop of around 2%. So that's very positive.